Good evening, everybody, viewers all across India. Welcome to this webinar on the tax amendments to Income Tax Act on account of demonetization, especially 3 sections which are very relevant and they have been amended. Of course, there was a motive, but then demonetization had created a lot of difficulties, and this is also one of them. The amendment we'll see, of course, during the course of the talk of Sri Mahendra that under 15 BPE, the amendment which has been made for the purpose of covering those cases where people are taking undue advantage, is going to hurt all of us in various other manners also, even post demonetization. So a lot of issues are going to emerge in this new area. 115 BE. Also, there are 2 penalties which are going to be discussed today, and therefore one will be able to understand the real implication of this provision. Some final issues are going to be discussed in this webinar, and we are really thankful to Sri Mahendra Sanghvi, our past president, who has agreed to lead this discussion and share his wisdom with all of you. With this, I welcome you all, and I am sure that you will have a very happy learning. And whenever if you have any question, if you please keep on typing in the dialog box, and we will try to address all the questions towards the end of the session. Maybe last 10 or 15 minutes we'll keep for the question answer session, and Mahendra will definitely be able to answer all your doubts which you have in your mind. With that, friends, welcome to this webinar, and have a very happy learning. Before I request Mahendra to start the discussion on the topic, may I request our convener, Mr. Dinesh Poddar, to formally introduce Mahendra. Of course, Mahendra is known to all of us, but Dinesh will have the privilege to introduce Mahendra. Thank you.
Thank you, Ketan. It's my proud privilege to introduce Mahendra Sanghvi. He is a practicing chartered accountant. He is a partner of Sanghvi and Sanghvi. He is a past president of Chamber of Tax Consultants. He is chairman of Law and Representative Committee of Chamber of Tax Consultants. He was nominated as member of Regional Direct Tax Advisory Committee by CBDT. He is a member of Standing Committee of TDS for Mumbai Region, Commissioner of Income Tax TDS, was co-opted member of Direct Tax Committee of WRC of ICI, is a member of Direct Tax Committee of Indian Merchant Chamber. He has written papers and given various lectures in the meeting organized by Chamber of Tax Consultant, BCA, Institute of Chartered Accountant. He has written various articles in newspapers of professional interest. He has also contributed to the referential manual of WRC ICI, given lectures during training session to the public sector companies and orientation program for tribunal member. With this, I introduce Mahendra Sanghvi, and I request our chairman Ketan Vajani to present a memento as a mark of love and affection. Thank you.
Thank you, sir. Good evening, friends. Many thanks to Ketan Bhai and to Dinesh Bhai. Dinesh Bhai, thanks for the kind words that you have used for introducing me. Ketan Bhai very rightly mentioned during the introductory talk that the implications post demonetizations on account of the amendments that has been carried out are going to be far-reaching. Not only that, it would not be restricted only to the extent of demonetization. Going ahead further, the provisions that are covered, the sections that are covered for under section 115 BBE are in our regular course that we do come across. In the talk later, we will see that how these implications are having far-reaching effect and how dangerous they would be. The only unfortunate part, I would say, is that the members, not only the members, even the practitioners who are into practice of direct tax, maybe either they have not fully aware about the same, the provisions or the effects of what it is going to be like. Because of that, even the community which are going to be affected, that is maybe the business class or any other SSC, the impact of that also would be very, very dangerous. As we see ahead, the tax implication, the criminal provisions that have been introduced by way of the Taxation Law Second Amendment Act 2016, how dangerous they are. Before we start with the section proper, let us understand the reason for amendments. Why these amendments were required in between the year. Otherwise, normally these type of amendments are always always seen during our finance bill, but they have been inserted in between the year in the month of November and December. The reasons for this amendment were, we also know that during IDS, Income Disclosure Scheme, tax experts had opined that it is possible for SSE to declare undisclosed income in assessment year 17-18, might as well declare in regular return of income and pay tax at the rate of 30% instead of paying the tax at the rate of 45%, which was the rate to be paid if the income is declared under section, if the income is declared under Income Disclosure Scheme, that is IDS. And after demonetization, deposits made on account of demonetization may be voluntarily declared by the SSE in his return of income for assessment years 17-18 as income from other sources and pay tax at the rate of 30%, applying the specified sections. By doing so, penalty under section 270 capital A can be avoided, as there will not be any underreporting of income. This opinion was discussed at various forums, in public, on social media, and in various newspapers. We have seen recently that government, including the CBDT, has started acting and reacting very fast. After demonetization, some officials said in news that penalty at the rate of 200% shall be levied on unreasonable and disproportionate income of cash which has been deposited. Having realized that pre-amended provisions are not capable of levying penalty, if cash deposited has been voluntarily offered to tax at the rate of 30%, they have made amendment to section 115 BBE, and a new penalty provision has been introduced by way of section 271 AAC, and this is applicable from assessment year 17-18. Let us, having this background, let us understand the objects and reasons given by the Finance Minister on 26 November 2016 when this was introduced as a bill in the Parliament. It said that evasion of taxes deprives the nation of critical resources which would enable the government to undertake anti-poverty and development programs. It also puts a disproportionate burden on the honest taxpayers who have to bear the brunt of higher taxes to make up for the revenue leakage. As a step forward to curb black money, banknotes of existing series of demonetization of the value of 500 rupees and 1000 rupees issued by the Reserve Bank of India have been ceased to be legal tender with effect from 9th November 2016. So it said that this is one of the steps to curb the black money. Going ahead, it said, concerns have been raised that some of the existing provisions of the income tax which we referred to in the opening remarks of my this this section, that some of the existing provisions of the Income Tax Act 1961 could possibly be used for concealing black money. It is therefore important that the government amends the Act to plug these loopholes as early as possible so as to prevent misuse of the provisions. The Taxation Laws Second Amendment Bill 2016 proposes to make some changes in the Act to ensure that defaulting SSCs are subjected to tax at a higher rate and stringent penalty provision. This gives what is the reasons and the object of introducing this Taxation Law Second Amendment Act 2016. Now friends, let us understand what are the nuances of this section 115 BBE. Let me tell you that this section 115 BBE is not a new section. There has been amendment made under section in this section 115 BBE. Sections which have been dealt in section 115 BBE are section 68, which we all know are cash credits, 69 unexplained investments, 69A unexplained money, 69B amounts of investments etc. not fully disclosed in books of account, 69C unexplained expenditure etc. and 69D amount borrowed or repaid on hundi. This I will again touch upon after we deal with section 115 BBE. So I have decided first to take up 115 BBE and thereafter these sections which are covered in 115 BBE. Now this section is inserted by Finance Act 2012, that is with effect from 1/4/13. Relevant is assessment year 13/14. So section 115 BBE is introduced from assessment year 13/14. Now that means we let us first of all read this effect of introduction of this section. In Finance Act 2012, this section was introduced, and wherein it said, if additions are made under section 68 to 69D, hereinafter I will refer to these as a specified sections, and SSC having losses under other heads of income, setup was possible, and where SSC is an individual or an HUF which are taxable slab-wise, no advantage will be available and SSC will still pay tax at the rate of 30%. To explain more in detail, let us understand there are now three periods. That is the first period which is prior to this introduction of this section, that is prior to assessment year 2013-14. Then after again we see when there is an amendment to this section. So that is the second period which is from assessment year 13-14 to assessment year 16-17. And the third period is from assessment year 17-18 onwards, and which we will be discussing that in detail. Now during the first period, that is prior to assessment year 13-14, we all saw that if there is any income which is already offered in the return of income, in that case, even if you are not able to explain the nature and the source of that income would be treated as if it's your regular income, and it will be taxed on the basis no special rates will be applicable, and it will be taxed as a regular income. Thereby, a person who has a loss under other heads of income, that loss would be available for being set off against this income which is being offered, and an SSC, if he is an individual or an HUF, because the income is taxable slab-wise, or if the income does not exceed the maximum marginal limit, that is a 2.5 lakh, in that case you would get the benefit of that below being 2.5 lakh, thereafter the slab-wise benefit of 10%, 20%, etc. So this was the advantage which was available prior to assessment year 13-14. So when this section was introduced by Finance Act 2012, at that time the Finance Minister had, in his opening remarks, he had, before introducing this section, he had said that we have realized that the people are taking advantage and trying to tax their income at a lower rate of tax. To curb that advantage, this section was introduced, wherein this section said that if such type of income which is covered under section 68 to section 69D, that is the specified sections, in such cases the tax will be paid at the rate of 30%. That means no tax slab benefit and no set off of any losses would be available under this section. And now we have another amendment which has come from 15th December 2016, via the Taxation Law Second Amendment 2016. And they have said that this is effective from assessment year 2017 onwards. Now, the subsection 1 of section 115 DBE is substituted. What does subsection 1 say now? Where the total income of an SSC, A, includes any income referred to in section 68 to 69D, that is specified section, and reflected in the return of income furnished under section 139. So if an SSC has already offered the income which is covered under these specified sections, and the return is furnished under section 139, or B, determined by the assessing officer, and that by determining that income falls in one of these specified section, in that case the income tax payable shall be aggregate of A or B, and the amount of income tax calculated on income referred to in clause A and B is to be taxed at the rate of 60%. And the amount of income tax which the SSC has already offered in clause A, you would get the deduction thereof. So to summarize that, I would say that whether the SSC is falling in clause A, he so much offers in his return of income, in that case, or if the SSC has not offered in his return of income, maybe he has either not offered at all, or he has offered that source of income which is not been explained to the satisfaction of an AO, but it is offered in under any other heads of income, and maybe even if it is offered in income from other sources not covered by these specified sections, in that case also it will be in DBE which would be triggered. And the amount of income tax with which the SSC would have been chargeable had his you have a slow connection. There is some issue on technical. Let us rectify it. In the meantime, we still proceed till the technician comes. Okay. The amount of income tax with which the SSC would have been chargeable had his total income been reduced by the amount of income referred to in clause A. Let there be some rectification. Would you like to hide the webcams and stop sharing your webcam if you are doing so?
Okay.
Okay. If you have it, it is better.
People can see it.
Whether, yeah, if it is possible, that makes a difference. Okay.
सर मैं वो दिखाऊंगा सर सबको वो भी दिखेगा सब प्लीज आएगा तभी दिखेगा
Okay. All right. All right. There was some pause was on some technicalities. Okay. Now we go to that earlier, friends, for assessment year 13, 14 to 16, 17. As we have just discussed, the income was taxed at the rate of 30%, which was increased by the second period to 60%, which was increased now to 60%, that is in the third period. Though, friends, just when we started with, we saw that the finance minister at the time of his speech gave the reasons that though demonetization is that on account of to curb the black money, demonetization one of the steps, and the second step is this. But it does not restrict to the demonetization only. Nowhere in the section, if you see that it has mentioned that it is on account of demonetization. Therefore, friends, when we later part when we will see that any additions made or any income treated under these specified sections will be taxed at a higher rate, a special rate, which we saw is 60%. And let us see how the 60% is going to increase. Now, secondly, they have made now two compartments of this section. Earlier, there was no provision to say that the SSE has so much to offer in the return of income. Whereas now, the first compartment says that the SSE has offered in his return of income furnished under section 139. So that is these are the two major changes which has made this amendment in this amendment. Okay. Now, tax effect on account of this amendment. The amendment is made in chapter 2 in section 2 of subsection 9 of the Finance Act 2016. Therefore, prior to amendment, if the total income exceeded specified amount, only then surcharge was applicable. What I'm trying to say here is that only if the total income exceeds certain threshold limit, say for example, if it was an individual, it would have been income exceeding 1 crore. If it was a firm, then 10 crores or a partnership limit, etc., depending upon the assessment year. But by making an amendment in the chapter 2, the surcharge of 25% will apply to the income determined under section 150 BBE, irrespective of the total income. So even if an addition of 50,000 is made, in that case also a surcharge of 25% is to be included on that 60% tax. Therefore, the effective rate will be 60 plus 25% surcharge and 3% cess on the total tax and surcharge, which will work out to 77.25% as against the 30.90% which was there in the earlier year. To understand more clearly and what would be the implication, a small example and illustrations is explained by way of this slide. An SSE who has filed the return of income from business, which says 50 lakh rupees. Income from other sources, he has shown tuition fees received under section 68. So moto the SSE has offered that this income is under section 68 in the tuition fee income because the person is not going to be able to explain the nature and the source of that income. So 10 lakh rupees, the total income 60 lakh rupees. Now tax effect. Before the amendment, I am ignoring the surcharge and the cess then the tax straight away comes to 16.25%. Now, this income at the time of assessment, the 5 lakh rupees, there was a receipt which was included in the business income. The assessing officer is not satisfied with the explanation of the nature and source given by the assessee. Therefore, the 5 lakh rupees is also treated as an income under section 68. Which comes, the total income remains the same, that is 60 lakhs each, only there is a transfer of 5 lakh rupees which is reduced from the business income and increased as income from other sources under section 68. The tax effect from 16.25 remains the same prior to this amendment. Now, after this amendment, again I am ignoring the surcharge and the cess. In that case, the income would, as per the return of income, the tax would be 19.25 lakhs, and the income assessed would be 20.75 lakhs as per the given into, because of the special tax under section 115 BBE. In addition to that, there would be a penalty under section 271 AAC at the rate of 10% of rupees 3 lakhs. On rupees 3 lakhs, that is 0.30 lakhs, which will come out to 21.05 lakhs. That we will, in detail, we will discuss the penalty provisions when we come to the slide of 271 AAC. Okay. Now, what does subsection 2 of section 115 BBE say? This has not been amended, which should have been suitably amended. Now, it says that notwithstanding anything contained in this act, no deduction in respect of any expenditure or allowance or set-off of any loss shall be allowed to the eligible assessee under any provision of this act in computing his income referred to in clause A of subsection 1. Therefore, what it talks about is that this no deductions will be, no expenditure will be allowed, or the set-off of any loss will not be allowed if it is under clause A. That means when the assessee has so moto offered the income under this specified sections, no expenditure and allowance will be allowed. Does it mean that if it is offered under clause B, it will be allowed? We will discuss this when we come on the issues part. Now, prior to amendment, it was considered that it is always the assessing officer's prerogative to invoke the provisions of section 68 to section 69D. If the assessee during the assessment is not able to explain the nature and source of it. Now, after the amendment, the assessee is permitted to disclose his unexplained income on his own in the return of income. Because as per clause A, we saw that the assessing officer can so moto offer this income under the specified section. So there would be two issues on this. Number one, can we say that this is a perpetual scheme to declare the undisclosed income that can be the scheme which was in IDS offered 45% of tax. The scheme which was in Yojana, that is Pradhan Mantri Yojana, that was 50% tax plus 25% you need to keep as a deposit for 4 years, which is interest free, etc. So virtually 75%. And now this is a perpetual scheme of to disclose your undisclosed income under this specified section and pay tax at the rate of 77.25%. The answer to this would be yes. The second issue we will deal little later when we try to analyze in a nutshell the specified provisions, that whether the assessee is himself been able to or allowed to offer the income under these sections. Secondly, the major concern, what we all will be facing now when we file the return of income of the SSEs. For the two reasons. Number one, if it's a company, they have amended Schedule 3 to see that whatever the deposits are made during the period from 8th of November till 30th of December, whatever cash deposits have been made by way of the demonetized notes, that is SBNs of ₹500, old notes of ₹500 and 1,000, and another column which says that deposits made in the regular notes. Secondly, while analyzing the bank accounts of any of the individuals, at that time also we need to report in the return of income the cash deposits made during this period. What are the effects that we are supposed to advise on and take the call? Let us understand that. And mind you friends, because there is a separate disclosure even in the return of income, even in the audit reports, one needs to be careful because that will be very easily catched, and depending upon the past deposits, the return of income regularly filed by the SSEs, this will become important, otherwise it will trigger, and there are all the chances that that could be the reason for selection of your scrutiny assessment. So number one, if the source of income represented by deposit of specified bank note, that is SBN, can be explained that such income is not to be taxed under section 115 DPE and will be taxed at normal rates as applicable to the SSE. If it is not explainable, then it is better that the SSE offers this source of income, which will be taxable at the rate of 77.25%. If it is not explained, and as I just mentioned, that there are likely chances, all the good chances that this could trigger for your selection of scrutiny assessment, in that case, the tax will be payable at the rate of 77.25% plus the penalty at the rate of 10%. Therefore, one needs to take the call, number one, whether he should offer the income at all. If it's a small amount, one can explain that it was out of my opening cash in hand, or if it was out of my earlier withdrawals made, or out of my past savings, which we will just run through that, what happens about the statements given by different authorities, whether that has any impact. We will discuss upon that also. But one needs to take a call depending upon the SSE size of his return of income being offered on the regular basis, and secondly, the nature and the source, whether that can be explained, and third, if it is not explained, whether he should offer suo motu or he should wait till the department catches that. The call will be, it's subjective, and one needs to take the call accordingly. Now coming to the second part, that is what happens to the assurances given by the officials. We all are aware, friends, that in the immediately after 8th of November, that is the demonetization, assurances were given by the government that if the cash deposits of up to 2.5 lakh, there shall not be any inquiry in the cases of small businessmen, housewives, artists, labor, etc. And this, mind you friends, were even displayed by way of advertisements and on the media also. Thereafter, Honorable Prime Minister on 12th of November made a public announcement that deposits of notes up to 2.5 lakhs made by married women, only married women, will not be subject to any sort of inquiries. So in between from 9th to 12th, there was already a restriction. Earlier it was businessman, housewife, artist, labor, etc. And then after on 12th, Prime Minister saying that only married women will not be subject to any sort of inquiries. But friends, no official circular was issued immediately after this statement made by the Prime Minister. Representations were made by various authorities, including Chamber of Tax Consultants on 14th, requesting to please kindly clarify so that there would not be any ambiguity or dispute later on. Now, we have already seen that instead of clarification coming as regards 2.5 lakh, there is absolutely no whisper on that clarification, but we have an amendment to these provisions by way of 115 BBE, which says that even a small amount of 50,000 may be subject to inquiry. The question may come that whether the assurances given by these officials have any value, or can we say that it would be a promise of estoppel, because these assurances were given by the highest authorities, by the finance ministries, by the Prime Minister, and even the advertisements are available and those assurances are available on the media. Whether that would give a support that, look, it was because of these amendments that the person has deposited and there should not be any inquiry to the extent of at least 2.5 lakh. That will, the time will say after the returns are filed and whether they are accepted or they are subject to some inquiries made by way of some scrutinies thereafter. Now, friends, simultaneously what they did was they had amended a rule which we all are aware, that Rule 114E. Now, this Rule 114E is on furnishing of statement of financial transaction. Mind you, friends, first of all, let us understand what was the heading given prior to 1416. From 1416, they have amended this rule by changing the heading. They have made this, earlier it was the annual information report, which we all practitioners would still understand that it's an AIR, section 285, which talked about saying that you are supposed to give information by way of this AIR, and now this AIR has been replaced by SFT, which talks about statement of financial transaction. Yeah, just now Ketan Bhai brought to my notice that if not, even if the inquiry is being made, and if you are made subject to payment of taxes at the rate of higher rate, that is at the rate of 77.25%, at least the penalty can be avoided on account of these advertisements and the assurances given by. I agree with that, Ketan Bhai. Yes, at least the penalty can be avoided, which that could be a reasonable cause which can be looked upon independently. I agree with that. Okay. Coming to the cash deposit, coming to this Rule 114E, up to serial number 12, there is no dispute, but they have introduced two serial numbers, that is serial number 12 and 13, which in our slide it will be 1 and 2, which will resemble, one would resemble serial number 12 of the Rule 114E, that is the relevant form, if I mistake not, is 61A. 61A. So serial number 12 of 61A I would say that it would read like this, and which is with effect from 15th of November 2016. That is the day simultaneously when the amendment has been introduced by way of second taxation amendment law. This rule has been amended, which says cash deposit during the period 9/11/16 to 30/12/16 aggregating to 2,50,000 or more in one or more current account of a person, or 2,50,000 or more in one or more current account other than the current account. So in any of the accounts, if the deposits of cash has been made, because current account would even include, or even if it is not included in first, then it would include in second, that is the cash credit account, overdraft account, savings account, or any RD accounts, etc., etc. So the persons who are supposed to report, that is the banking companies, so all banking companies, all the banks, as well as the post offices, wherein they find that any person who has deposited more than 2.5 lakhs, during this period, they are supposed to report. And this reporting, the due date for this reporting was that they were supposed to furnish this information before 31st of January 2017. So within 1 month, they were supposed to upload it, and we understand that banks and the postmasters have carried out this activity, and now it is the back office of this the person that is the director of intelligence and criminal, etc. They are investigating all this and trying to collect and bifurcate the data, and thereafter take the necessary action, which has already started. The second part, which is the cash deposits during the period 1/4/16 to 9/11/16 in respect of accounts that are reportable under serial number 12. So the person whose accounts are reported on account of serial number 12, they will have to report this even if the cash deposits during the earlier period. So this is nothing but a direct. We can understand that the banks are supposed to report this so that the director of intelligence and criminal wing would be able to have a comparable study that what was the cash deposited during the earlier period, right from 1/4/16 to 9/11, and what is the cash deposited during this period. There would be a direct mismatch in many of the cases for the various reasons. Number one, I would say, supposing throughout the period from 1/4/16 to 9/11, I have not deposited any cash. But in the month of November, I have withdrawn some cash, say 5 lakh rupees has been withdrawn for my regular office expenses, which includes the salary also. But no salary payment was made till 8th of November. All the expenses which were supposed to be incurred during the subsequent period, the expenses have not been done, and there has been a cash in hand balance of 5 lakh, same 5 lakh rupees, which was earlier not deposited, never in the life of this, never in this period, or because it is cash in hand on 8th of November. Now today they were all in the SBN, that is the old demonetized notes. They had to be deposited. So there would be a deposit of rupees 5 lakhs. Now, there is nothing mentioned right now over here that whether that deposit is out of the cash withdrawn. Only the bank will have to show that yes, this cash has been deposited in this period, that is serial number 12, and there has been no cash deposits in serial number 13. So there would be a direct mismatch. Second example which I could readily think of is a person having a savings of his life, a senior citizen, and that person has deposited rupees 2 lakhs in this period from 9/11 to 2012, but that person has never deposited earlier period. But he has a sufficient good reason which can be explained. But here prima facie this explanation will not be offered, and possibly that could also be a reason of mismatch. Thirdly, a person having cash in hand as on 1/4/2016, which he is not required to disclose in the return of income. However, he can very clearly demonstrate that yes, this was the cash in hand available to me as on 1/4/2016, and he has deposited this cash in hand. Maybe he has always a practice of keeping this cash in hand handy, so that in case of emergency, it can be used. Now that this notes becoming not workable, he had to deposit this during this period. Even that could be a reason of mismatch, and these issues, various such type of issues will trigger, because that explanation cannot be given by this banking company who is supposed to furnish the statement under this SIF. Now let us understand these specified sections, because these specified sections are going to play a major role as far as the taxability under section 115 DBE goes. I have already touched upon this section, that is from section 68 to 69D, what are the headings of that section. I have in brief just summarized this, what it talks about. Number one, section 68, tax credits, which we all practitioners are very well aware about. It reads that amounts credited in the books of account of the SSC, the nature and source thereof is not satisfactorily explained by the SSC. So therefore, with effect and with effect from assessment year 13-14, a proviso is inserted wherein a closely held company has received share application or share capital, share by whatever name you may call, and in such case, the source of that application is not only required, the source of the source is also required to be explained to the satisfaction of the AO. And if that nature and source is not satisfactorily explained, the assessing officer may assess that income under section 68. Now, having this background, that number one, the assessing officer may assess this under section 68. So one, whether this may is to be read as shall, or still the assessing officer has a choice to treat this as section 68, or can he treat this as any other text other than section 68. And second issue would be whether where we read that under clause A of subsection 1 of 115 DBE, the SSC has an option to so to offer this income under section 68. We saw the wordings of the section 68 are framed in such a way that section 68 talks about the assessing officer is not satisfactorily satisfied with the nature and source, then he will treat this as an income under section 68. Now, if an assessing officer is supposed to treat this as an income under section 68, there is a choice available, or is it an option available to the SSC that yes, still he can so to treat this as an income under section 68, or for that matter, the wordings are similar for all these specified sections. This being the case, whether the SSC has an option to offer this income under clause A of section 115 DBE. Since independently, if you ask me that the section has made a provision under 15 BBE, and it says that yes, under the specified sections, if the SSC Act so moto offers in the return under section 139, he will be taxed at the rate of 77.25%. And this being a later section which has been introduced and which takes notwithstanding anything contained in other provisions will be taxable at the rate of 60% plus the surcharge, etc., etc. I would, in my view, it can be easily construed that yes, the SSC will also be able to offer suo motu under this clause. Second, section 69, which talks about unexplained investment. Investment, and coming to this cash credit, friends. Now, nowhere in section 68 they have mentioned about this demonetized note. The section 115 BBE of 30%, the amendment to this of 30% to 60% is on account of demonetization. On account of the link is demonetization, and thereafter the finance minister said that yes, we are amending these provisions also. So people wanted to deposit cash in bank on account of demonetization. The people who have not offered in ICDS at the rate of 40%, maybe that account also they have made it 60%, something higher than the 45%. Taking all this together, then they should have restricted for only cash deposits during this period in the specified notes. Or maybe they should have amended to say that yes, the cash deposits which are in this specified notes and which are in the, during this period, that is from 8/11 to 30th of December, those will be covered at the rate of 77.25%. That not being the case, what they have gone ahead and they have amended straight away to include all the provisions hitherto, that is from assessment year 17-18 onwards, to be taxed at a higher specified rates. The outcome of that will be tomorrow the assessing officer, if he is not satisfied with any loan, the explanation or the nature, you have given certain explanation, you have filed a loan confirmation, you have filed a copy of the return of income, which in proportion to the loan given to an SSC is much, much lower. Say a return of income of a person whose loan you have taken happens to be a private limited company. You have taken a loan of 50 lakh of rupees, but the return of income of that private limited company shows only income of rupees, say a lakh, or even for that to that extent nil income. The assessing officer will say, no, it's not the SSC who is offering a nil income, that is a private limited company, who is offering a nil income, and he has given a loan of 50 lakhs, he does not have a capacity. He does not make any further investigation, and he straight away makes an addition under section 68. This section, whether this addition of 68 or is correct or not, that will be a different dispute which will be carried out by the SSC in appeal. But in the meantime, a demand will be raised at the rate of 77.25% plus this penalty of 10%. And which we all saw that before this March ending, that all the officers were hither bound to make sure that at least 15% of the tax is paid, so that then only they will allow you for the balance stay of demand. Otherwise, all harsh actions were taken to the extent that the accounts were seized, 220 notices were issued, etc., etc. And now you will have to pay this 15% tax, And mind you well, it is not that they can stop at 15%. Definitely there is a circular. So the SSE can take an advantage of this 15% and stop him by only 15%. But today this 15% will be 15% of that 77.25%. Otherwise it would have been 15% of only that 30%. So tomorrow, if an assessing officer wants to harass you or trouble you, or if he does not make an appropriate inquiry, for whatever reason, best known to him, maybe for want of time, or he doesn't want to go ahead, or he would just say that, yes, for the documents available before me, I have all the reasons that, yes, this source and the nature is not properly explained to me, so I am treating this as a cash credit. Similarly, from assessment year 13-14 onwards, if a private limited company has received some SAD application money from an individual, which includes even share premium amount, the assessing officer would just make a simple statement that you need to explain me the source of this share application money along with the premium that you have received. If the assessing officer says no, what the explanation given by you is not satisfactory, you have not been able to explain me the source of this source, maybe you are not a relative also of the person from whom you have taken this loan, still the onus is on you that if you have taken a share application from Mr. A, you need to show that yes, Mr. A is the source of Mr. A. From where did he give me this share application money is up to the satisfaction of the A. The source of source is also required to be explained, thereby a complete dilution of all the Supreme Court decisions which said that source of source is not required to be explained in case if he is not your relative. So lovely exports, etc., all other judgments also get sense diluted. Here again, on account of that, trigger to section 68, thereby to section 150 BBE. So these are the type of implications which we need to know before we file the return of income or at the time of assessments which will we be taking up from assessment year 17-18 onwards. The second one is unexplained investments, section 69, excuse me. Thank you. Here it talks about amount of investments. These are not the actual wordings of the section. I am sure that you can refer to it later also, but I have just given the gist of those section. Amount of investments made by the SSE which are not recorded in the books of account and source thereof is not satisfactorily explained. Friends, now because of this financial reporting which we earlier used to call AIR, there are various authorities who are uploading this, who are required to upload these details by way of the rule which we have already seen, 114. Now, when we saw that under the rule 114E, under various serial numbers, even if you have made an investment in bonds of the limits higher than the limit specified, those authorities will be reporting under SIF. And on account of this PAN number, your assessing officer will be informed. And if that has not been explained or disclosed in the return of income submitted by you, and if you are not able to explain that investments or the investments explained are not satisfactorily accepted by the assessing officer, in those cases, section 69 will be triggered, and again, COA 115 BBE, you will be paying the taxes accordingly. Similarly, we have unexplained money, etc. Now that talks about money and the value of bullion, jewelry, or other valuable article of which SSE is found to be the owner and which is not recorded in his books of account, and the SSE offers no explanation about the nature and source of such money, bullion, jewelry, or other valuable article, or the explanation offered by the SSE is not, in the opinion of the AO, satisfactory. Now here, more particularly, this problem will be in the case of search. When a search is conducted, you find jewelry, bullion, or other valuable articles, paintings, etc. And the SSE is not able to explain, or these are not recorded in the books of accounts. Section 69A will trigger. Similarly, we have 69B, where the amounts are not fully disclosed in the books of account. Where these investments which were in 69A, they were not disclosed at all. In 69B, they are not fully disclosed. The value which should have been offered or should have been disclosed, they are not disclosed in the books of account. Those 69B will trigger. I understand that there could be various queries. One of them would be saying that a person who is not disclosing the jewelry or bullion in the return of income file, how is he supposed to disclose when there is no requirement to submit the balance sheet? And even if there is a requirement, there may not be a necessity that an SSE would have offered this or disclosed this in the balance sheet, because of that these jewelries which are received are either by way of Sridhan or the gift or on birth or on various different occasions, on marriage, engagements, birth dates, etc. All these jewelries being in the nature of gift received during the period or during the life of the SSE, they are not being any cost to the SSE. They are not offered or disclosed in the balance sheet. Will those type of jewelry also be covered under Section 69, treating at these are unexplained investments? Or whether this can be covered under Section 69A or 69B, that they are partly disclosed or they are not disclosed at all? The answer to that would be, in my opinion, here though it talks about the books of account, but if they can be explained that they are below the limits which normally the department allows at the time of such actions, that is 250 grams for in the case of non-married and married, those up to 500 grams, etc. In that case, I think it should not create any problem for an SSE, and Section 69A would not be it. Secondly, if a person has any time filed a wealth tax return, maybe before 2015, I understand that now there is no requirement to file wealth tax return because of the repealment of the Wealth Tax Act. Prior to that, if he has filed before 2015, in that case, or before the limits were increased, or before the structure of the wealth tax has been changed, if any time you can prove that yes, this was the jewelry which was already disclosed to the income tax department once, so you cannot treat this as an undisclosed income and cannot be taxed under Section 6, the specified sections what we have been explained. The next that puts me is to 69C, that is unexplained expenditure. Now here, friends, if any expenditure incurred by an SSE and it is not satisfactorily explained, the question would come, how would the department know unless I have shown this expenditure in my books of accounts? Yes, prima facie, if you ask me, if an assessing officer sitting in his office, he would not be able to find that yes, there is any expenditure which is not explained. However, there are now different ways which the assessing officer can collect information, or if he has already had some information that yes, you have certain occasions during the relevant assessment year, and during those occasions you have spent X amount of expenditure, and those expenditure are not reflected in your return of income which have been filed, maybe by way of your withdrawals or any other way, if that is not explained, but that information being part of the information available to the assessing officer, he can always ask you that what is the source of this source of this expenditure. If the assessee is able to explain the source, that yes, this was spent by my parents or by my relative during the occasion, maybe during the marriage, if that is satisfactorily explainable, in that case that is okay. Otherwise, this would trigger under section 69C and it will be treated as an unexplained expenditure. So mind you friends, if you are spending by way of any occasions, having a big size party in some gymkhanas or some big halls or 5-star hotels, they are required to submit this information by way of Rule 114, as we saw earlier. And if they are not, and if that cannot be explained, then even the credit cards, even if you have spent the credit cards above the X amount, maybe this credit card is an official credit card which you are spending it for a business purpose. Those expenses are debited to the respective profit and loss account. That would be an explanation, satisfactorily explained. But if you are today making the purchases by way of credit card through any of the e-commerce platform, maybe Amazon, Flipkart, etc., whether you spend by cash, you spend by credit card, they have a trail of it. And if that is available with the department, you are supposed to explain that to the satisfaction of the assessing officer. Similarly, we have amount borrowed on or repaid on hundi. So under any of these specified sections from 68 to 69B, if you are not able to explain to the assessing officer to that satisfaction, the sections will trigger and you will be trapped under section 115 BBE, and you will be required to pay tax at a higher rate, which we have already seen, which will come to 77.25%. Now, this is what I wanted to explain to you as regards section 115 BBE. Now, the second section which has been allotted to me is section 271 AAC. Now, which is also been introduced, inserted along with the same amendment which has been taken in 115 BBE by the same taxation second amendment law, and it also works with effect from 1/4/2017. The question may come whether it is a retrospective. To me, it would not work as a retrospective because of two reasons. The same question may come whether 115 BBE also, that 77.25% is also retrospective. By way of Finance Act 2016, I would say that it is not retrospective, but it has been workable with effect from 1/4/2017, and similarly is this provision 271 AAC. What does this say? The assessing officer, subsection 1 says the assessing officer may, notwithstanding anything contained in this section other than provisions of section 271, AAB, which will also deal with that little later. Direct that in a case where the income determined includes any income referred to in this specified section for any previous year, the assessee shall pay by way of penalty in addition to tax payable under section 115 BBE a sum computed at the rate of 10% of the tax payable. So in addition to what tax you have been paying under 115 BBE, in any case that is way high, that is 77.25%, he will be required to pay tax at the penalty of 10%. Now the issue may come up. Coming to the penalty, how I just bisect this section, which says that penalty is leviable when if the total income determined by the assessee officer includes income referred to in this specified section, and if the assessee has furnished this return in his return of income, and he has even paid the taxes before the end of the relevant previous year. So therefore, number one, the penalty will not be levied if the assessee has offered in his return of income and he has even paid taxes by way of an advance tax before the end of the financial year. Under these two conditions, the penalty will not be levied. Otherwise, the penalty of 10% will be levied. The small issue which may arise is whether this 10% is to be paid of the 60% or 10% is to be paid of the 77.25%. Why I would say so? First of all, let me give you my view on this. In that case, I would say that the penalty of 10% is payable on the 60% and not on the entire 77.25%. Why 60% only? I would refer to the earlier slide, because it says the last sentence after the comma, a sum computed at the rate of 10% of the tax payable under clause 1 of subsection 1 of 115 BB. Now when we say that clause 1 of this section, so what does clause 1 of subsection 1 say? It says 60%. As in the opening slides, if you see, why this surcharge of 25% of the 60%? It is because of the amendment made to Finance Act. So therefore, I am of this view that it should be restricted to 60%. 10% will be qua this 60% and not qua this 77.5% or even 77.25%. I understand that there should not be any dispute as regards 75 or 77.25% because the same rationale. But yes, there are other views which are said that one school of thought, because Supreme Court has said in certain cases that taxes would include surcharge and cess also. Now, being that Supreme Court, but there the issues were not very clear, but here we have a clarity as regards the opening section itself. It reads that 10% of 150 tax to be paid under 150 BBE qua subsection 1 clause 1. Therefore, still understanding the Supreme Court decisions, my view is that it should be restricted to only 60%, only 10%. Now, I think, yeah, because of the subsection 2, we have certain areas which are again should be considered, that no penalty under section 270 capital A, that is our regular penalty provision for the concealment of income and underreporting and misreporting, would be applicable. That is, no penalty under 270 capital A due to underreporting of income shall be imposed in respect of income on which penalty can be levied under section 271 A. Secondly, penalty imposable under section 271 AAB, which we'll be dealing with very shortly, due to search being conducted under section 132, simultaneously penalty can be levied under 271 AAC. So therefore, both can run parallelly, 271 AAC as well as 271 AAB. Now, what happens when it runs parallelly? What is the tax implication, the total tax implication on the person who has been searched? That we shall see by way of illustration a little later. Thirdly, provisions of section 274, which deals about the procedure for levying of penalty, that is, a so-called notice is to be delivered, penalty will be independently dealt with, and section 275, which deals on the bar of limitation of imposing of penalty, will also be applicable to 271 AAC. An order levying penalty under section 271 AAC is appealable. The issue I have taken this because if you see the section of appealable under section 246A, there they have not specifically mentioned that the penalty, that this would be an appealable order if a penalty is levied under section 271 AAC. However, if you see clause 1, subclause Q, there they have said that any order passed under chapter 21 is an appealable order, and 21 will fall. Chapter 21 includes 271 AAC. Therefore, this is an appealable order. Now, this brings me to another section and the last section, which is on section 271 AAB, which talks about amendment, which is again 15th by way of 15th December, and the Taxation Law Second Amendment 2016. This new section has been introduced, and where this deals with penalty where search has been initiated. This is not an, I'm sorry, this is not a new section. This is some amendments have been made to this section, which says that section 271 AAB provides for levy of penalty in a case where such has been initiated under section 132 of the Act. It applies to the undisclosed income of the specified previous year. I think here there is no dispute, because there are otherwise number of disputes as regards what is undisclosed income and etc. etc. That independently one has to look at it when they see provisions of section 132. And specified previous year, because here when we see that this 271 capital AAB talks about it applies to undisclosed income of the specified previous year, and specified previous year has been defined in the section, which means which has ended, the period which has ended before the date of search, but the date of furnishing the return of income under 139, once the search year has not been expired before the date of search, and the SSC has not furnished the return of income for the previous year before the date of search, or in which the search has been conducted. Now, this can be explained by way of an example that what period it could be. Sorry, excuse me. The period before that, let me take up certain issues which are not covered over here. On this 18th slide, what would be the rate of this? How does this operate, and what are the tax implications to this? Earlier, friends, prior to 15, 12, 16, there were 3 rates of penalty depending upon the case where it would fall into. Now, after this amendment, they have only 2, I would say 2 blocks when you need to pay the penalty and the rates prescribed in this. Two type of cases, and here earlier it was three type of cases. Now, which are those cases? Let us see that. And if you see the slide, it is old and new. That is, old means prior to 15, 12, 16, and new means after 15, 12, 16. So SSC admits during the statement made under section 132.4, that is during the search proceeding, when the statement is recorded under 132.4, and it specifies the manner and substantiates the manner in which the undisclosed income is derived. And he pays taxes including interest and furnishes the return of income. In that case, the 10% was the only penalty which was to be paid on that undisclosed income. So earlier, if you look at it, you were number one paying tax at a lower rate. Secondly, the penalty was also at the lower rate, that is only 10%. Now, despite you being offering this income, which is of undisclosed nature, and you are offering this under section 132.4, and you are specifying the manner and even substantiating that how this income is being offered, yet still you will be paying tax at the rate of 30%. Therefore, if you see that the rates, both even the tax rates have been increased substantially, and even the penalty provisions have been increased substantially. Secondly, the SSC Second, if you see, the SSC does not admit in the statement under 132.4, but he declares in the return of income and pays the taxes along with the return of income when he is made to file the return of income within the period allowed to him. In that case, he was supposed to pay tax at the rate of 20%. So therefore, if a person has missed the bus during 132.4, maybe for whatever reason, maybe under the pressure, he has not been able to allow to consult his consultant, and he has not offered in 132.4, but he has included this in his return of income and paid the taxes. In that case, instead of 10%, he was supposed to pay penalty at the rate of 20% only. Earlier provisions, but now it says that nothing doing. If you have not offered, if you have missed the bus under 132.4, you are required to pay a penalty of 60% of the undisclosed income. And the third one, not covered by above, wherein in the old provision it would vary from anything 30% to 90%. There they said that it is still 60%. So whether you fall, if you have not offered, now in the new regime, if you have not offered under 132.4, you will, even whether you offer in the return of income or not, you will be required to pay the tax at the rate of 60%. So therefore, the liability will, if you see, it is going to be 77.25% if you are not able to explain the manner and how you have the source, the nature source. If you are not able to explain, it would be 77.25% plus the 60% penalty which we just saw now under section 271 AAB, plus even the penalty as we just saw that both can be levied 271 AAB and 271 AAC, that is under section. If all together, if it is put to me, it would work out to 144.98%. So a person, if he is not able to show that this is my undisclosed income during search, if he is not able to substantiate the manner, if he is not able to explain the source, that income would be taxable under the specified sections, and the penalty including 271 AAC, including 271 AAB, he would be required to pay a total amount of tax at the rate of, broadly speaking, it would be 145%. Now this 145% for a person who has 1 lakh rupee of disclosed income, undisclosed income, he would be landing up paying 1,40,000. To be precise, it would be something on 1,43,000 something. So one needs to keep this in his mind. Now, before I end this session, let me run up with certain few issues which I would like to discuss. Issue number one, which is not there in the slides. These issues are not available on the slides. Where number one, the SSE under presumptive is covered otherwise under presumptive taxation has been regularly filing his return of income under presumptive taxation. Now, can AO treat any particular deposit? His return has been under scrutiny, and during the scrutiny, he has been asked to produce the bank statements. The bank statements are produced, wherein he finds that there is a cash credit of rupees 2 lakhs. Now, whether the SSE is required to show this cash credit, that yes, what is the nature and source of this cash credit, even if it is covered by the way of presumptive taxation. Friends, we all know that if a person, SSE, who is otherwise covered under presumptive taxation or 44AD or now 44ADA also, if he is a professional, that he is not required to maintain the books of account. Therefore, number one, if he is not able to maintain the books, if he is not required to maintain the books of accounts, whether still the assessing officer can say that look, this 2 lakh rupees which is appearing in your bank statement, if you are not able to explain this, I would apply section 68 and treat this as cash credit under section 68 and tax you accordingly, that is under section 115 BBE. The answer would be yes and no. Yes, by no, I would say that the assessing officer cannot tax under section 68 if the SSE is able to demonstrate that look, this 2 lakh rupees is nothing but part of my turnover, which I have already disclosed in my return of income, and qua that turnover I have offered 8% or 6% as required under section 44AD or 44ADA. I have already offered that income under presumptive taxation, and that being part of my turnover, no provisions of section 68 can be invoked. However, if the SSE is not able to explain that how did he arrive at the next figure of the turnover on which he have applied 8% or 6%, in that case, it would be very difficult for an SSE, since the books of accounts are not maintained, to show that look, this is part of my turnover or this amount is not part of my turnover. Therefore, before even applying the provisions of section presumptive taxation, one needs to see that all the credits appearing in the bank account are considered either by way of turnover, or they can be explained that this is not part of my turnover, or this is a loan, or etc., etc. And it can be explained to the satisfaction of the AO. In such a case, it would not be applicable. Otherwise, yes, 115 BBE will be triggered. Secondly, second issue is, as we saw that when we were discussing 115 BBE, subsection 2 when we discussed, which said that no deduction in respect of any expenditure or allowance or set-off of any loss shall be allowed to the SSE while computing 115 BBE. The question comes whether deduction under chapter 6A will be allowed. Because we all saw that yes, throughout we have been saying that a flat 60% plus surcharge, etc., will be levied on the income which is covered under specified section, and no deduction in respect of expenditure or allowance or set off of any loss shall be allowed. But it does not say anywhere that a deduction under Chapter 6A will not be allowed. Therefore, supposing there is a donation, whether the SSE will be able to claim the deduction of the donation amount from the income which is covered under this specified section. There is a debate, it is a gray area, but in my view, yes, because it's a specified section and it nowhere mentions that Chapter 6A deductions will also not be allowed, and it very clearly talks about expenditure. It is neither an expenditure. Allowance, it is not an allowance. Set off of any loss, it is not a loss, or that which are covered in either of the three. Therefore, it should be, in my view, allowable. As I said, still it's a gray area. The next issue is that, as you saw, there were two clauses, Clause A and Clause B. The Clause A talks about if an SSE so modo offers. The Clause B under subsection 1 talks about that if the SSE is not offered, but the assessing officer has treated this source of income under the specified sections. And subsection 2 talks about that the SSE cannot claim expenditure, allowance, or set off of loss in the return of income filed by the SSE. So therefore, if the SSE in his return of income he has so much to offer, he will not be allowed to claim any expenditure, allowance, or set off. But it does not talk about Clause B. And the Clause B, as I said, that the assessing officer, if he is treating this any particular receipt under the specified sections, in that case, whether this losses or expenditure or set off losses or expenditure or allowances will be allowed as a deduction. We expected that, yes, in a rush since these amendments have been carried out, there would be an amendment at the time of Finance Act 2017. But we have not seen any such amendment in 2017 also. But still, nevertheless, I still feel that this is nothing but a lapse, a procedural lapse, and which anytime can be carried out, will be carried out, and will start being and would still be workable from 1st April 2016. Therefore, from assessment of 17-18, this would start working, and therefore one should not take a chance and do his planning accordingly. Another small issue which I would like to take up is that we saw that for the purpose of levy of penalty under section 271 AAC, as per Clause A of section 115 BBE, a return furnished under section 139 is considered. So therefore, a return, if it is furnished under 139 and he has paid taxes, then no penalty is to be levied under 271 AAC. What happens to returns which are filed under 153A and 148? Whether those type of returns will also be covered under this section? Apparently, the reading of this section and the answer would be no, it should not be covered. But if a return is already filed earlier, which is covered under 139, and thereafter if an SSE is required to file a return under 153A or 148 on account of the search action or on account of a notice issue under 148 respectively, in such a case, if the original return was filed and which was covered under 139, there is a good scope that yes, still the return would be treated for the purpose of 271 levy of penalty under section 271A AC that yes, they were filed in under 139 and can be covered under clause A. That's what we just now saw. Another issue I would like to take up, and before I end, and that would be the last issue, can an assessee disclose income under section 150 BBE prior to assessment year 1617 and pay 30% and avoid penalty of 271(1)(c) also? Friends, we are aware that from assessment year 1617, the penalty structure has changed. Section 270 capital A is applicable and which deals under reporting. Now up to assessment year 1617, 271(1)(c) is there, and on account of that, a penalty which talks about that 271(1)(c) talks about if source is not explained, still it may tantamount to concealment of particulars of income or furnishing of inaccurate particulars of income. So where furnished, so if a return is to be, the return is already filed, and if you are planning to revise the return by offering some income, additional income, and paying only 30% of tax, then it could be said that still the original return, which is, unless you have some genuine reason to show that this is the income which remained, then only it will not amount to furnishing of inaccurate particulars of income. Otherwise, in my opinion, 271(1)(c) would trigger for assessment year 1670. Why I have raised this particular issue is that because there have been planning done that yes, if you have deposited the cash in bank account during this demonetized period, that is from 8/11 to 30th of December, of X amount, and if you are not been able to explain the source of this X amount, then you will be paying the tax at a higher rate. So it is better to revise the return of income for assessment year 1670 and pay tax only at the rate of 30% and show that this was your cash in hand lying with you, and that is what has been deposited in the bank account. So that would be a certain planning which people are trying to show that in that case one should not forget the provisions of section 271(1)(c). Friends, with this I would like to stop, but before that, Ketan Bhai says that yes, there are certain two issues, two queries which have been raised by the participants.
If there are some other questions, they can be asked. Before we finish these two questions, the participants will be requested to.
Okay, the participants can, before I deal with these two questions, the participants or who are there along with us over here are free to raise the issues so that that can be addressed to the best possible way I can deal with it. Yeah. Now, before that, we start with the two issues.
Let the people type in
the meantime, Ketan Bhai would raise the issues.
Yeah. There is one question which says that whether cash deposited rupees 250,000 with no opening cash balance should be shown as income from other source and charged to tax at normal rate, or should not be disclosed and contentment that it is his personal saving over the years.
Yeah, this issue I have already dealt, but maybe I would further clarify that this would depend upon a case to case. If it's say for example, if it's a senior citizen or okay. The question that is being raised is that if a person during this demonetized period has deposited 2.5 lakh, now whether that person is required to offer this 2.5 lakh and pay tax at the rate of 30%, or not pay any tax at all and show that this is out of my past savings. This is the issue. As I said, friends, this issue I have dealt, but let this being a specific case, again I would deal, and it would be depending upon the case to case. Number one, let us understand that a person who has been having sufficient withdrawals in the earlier year or two, and out of these withdrawals, these savings are there, and which it's a normal, I would say, in a society of Indian society, we always see that yes, there's a tendency of a female to have keep some savings with hers. Supposing a withdrawals are made from the husband's account, husband is giving the X, whatever amount has been withdrawn, he is giving the amount to his spouse to carry out the regular withdrawals for the household. Out of that, the female has been able to keep some savings, and that savings today now is again deposited either in the spouse's account or in the SSC's account. That can be explained provided there are sufficient withdrawals made by either the spouse or by the SSC. If that is not able to explain, if the SSC is not able to explain, then I would not be able to, then the SSC will not be able to justify that these are out of my past savings. Similarly, the second issue would be that whether he can say that this is out of my income of year and I am offering it at the rate of 30%. Now the question of 30% would not arise at all. Either it would be in his regular income if he can show that yes, this is the source of my income to the satisfaction of that AO. Just by saying that, look, this is out of my selling the pastries or my tuition income, to earn that tuition income, if you, number one, you should be qualified enough to give tuitions. To whom you have given the tuitions, maybe you may not be able to explain everything, that yes, from whom I have received the tuition, but you should be, number one, capable of giving tuition, capable of taking tuitions from the person whom you have given the tuitions. Your timing should be suitable to you. If you say that yes, my working hours, I am in serving and my working hours are from morning 8 o'clock to evening 6 o'clock, and I am giving tuitions to 10 persons, then that would not help. You will not be able to explain the source and the nature to the satisfaction of the AO. Therefore, it would not fit in your regular course of income. Therefore, and you will be have to pay the tax at the rate of 77.25%. Otherwise, if you can show, then in the regular income, that is slab-wise, you'll have to fall if you're an individual. You need not pay 30% also. So I understand that this should clarify the issue.
There is one more question. It says whether surcharge of 25% is restricted to assessment year 17-18 and will not apply to 18-19 onwards, because the rate of 25% is not mentioned in the Finance Act 2017.
It is.
Since rate of 25% is not mentioned, that lady is asking a question. Mentioned in the Finance Act 2017.
Yeah. If the question is whether the 25% is applicable for only assessment year 17-18 or is it applicable for assessment year 18-19? Now, friends, for assessment year 18-19, we will have to refer the Finance Act 18. So when the Finance Act 18 comes, we will have to see whether that has been retained in 25% is retained. Now, this Finance Act 17 talks about for assessment year 17-18. Therefore, for 17-18, it says that yes, it is 25% and it works for 17-18 only and not for 18-19. So we need to still wait for the Finance Act 18 to come. Yeah.
There's one question.
Yeah. There's one more question. Yeah.
SSC has filed wealth tax return for years, but jewelry is not shown in his balance sheet. Now, if he sells the jewelry, can it be treated under Section 69?
Yeah. Here the question raised is the SSC has regularly filed the wealth tax return, and in the wealth tax return, the jewelry has been offered and shown as an asset and paid the taxes accordingly. Whether paid the taxes or not depends upon the threshold limit of 30 lakhs, etc. but the jewelry is already disclosed to the income tax department. However, this jewelry is not offered or disclosed, rather not disclosed in the balance sheet which is filed in the with the income tax department. As such, the personal balance sheets are not required to be filed. Balance sheets which are required to be filed are the business balance sheets. Secondly, there is one clause or one schedule AL in the return of income wherein you are supposed to show that the jewelry at cost. Assuming there also you have missed out and you have not shown because the cost is not available. This jewelry was received on various occasions. In that case, that cost not been available, the SSC has opted to write it 0. Now 0 does not mean that he has not disclosed it, but already this has been disclosed in the wealth tax return, that means to the income tax department. And tomorrow if he's selling that, if he is selling this jewelry in the market and he is receiving the sale proceeds which is been credited in his bank account, this would not stand that this is your undisclosed income. This is your already disclosed income which has been brought in your books of accounts today. Yeah.
Again, nature and source.
So the nature is available. The source is, yes, the check, the sales proceeds are available from where he has received. The purchase he had already shown. So if at all.
Not sufficient.
So
even in case of this Caesar also they say there are two Caesars 500 they allow. So
I appreciate this 500 what they allow. Sharmaji, what is raising this query is whether this 500 is a threshold limit allowed. No, this is 500 is only the circular which is issued is only for the purpose of Caesar, that the officials should not seize this jewelry on account of the social obligations which are there and which the SSC in Indian society is receiving, or married women receives. I appreciate, but nevertheless, these are practically accepted that yes, this would be the jewelry which he has been receiving. That again would depend upon the I would say stature of the SSC and the custom. So still having this, I think this source of acquisition.
Declared in the bill tax return, that doesn't mean the assessing officer can ask for the nature and source.
Yeah, he can. Then for those, then it would be for those assessment year. Supposing the first return of wealth which is filed for his assessment year 12-13, assuming for a moment it is 12-13, and since 12-13 he is being regularly filing the return of income for March 15 also. In that case, the first year would be 12-13 if that wealth tax return which is filed is not, he is not able to show from where it is there. Then 148 can be issued for that respective assessment year being the first year, and in 148 if you are not able to show that where did you, how do you acquire this, then the provisions of assessment at 12-13 will be made applicable, and 115 DBE will not trigger because at that time it was not there, and 30% is made applicable from assessment year 13-14 onwards, which is at the rate of higher. And yes, if it is beyond 6 years, then whether they can reopen, the answer to that would be no. Subject to the limitations, they will not be able to go beyond
I think that
the
can also be a matter of
I know, it's a grey area again.
Because you are declaring tax return, it doesn't mean that you are acquired in that year. Unless because section 68, 69 in the financial year in which you acquired. So you should have some proof that you are acquired in, suppose 12 you have shown, but you are acquired in 15. Then it can be.
If the assessing officer is able to find out that yes, this is not the year of your acquisition, the year of acquisition, and the financial year of acquisition is the acquisition year in which it will be taxed.
There is a counter question which that lady has asked. She is saying that Finance Act 2017, which describes the rate for surcharge for assessment year 18-19, does not mention surcharge rate of 25%. I don't know what exactly.
No. This 20. I think I have clarified. Maybe you can call me. You can call me. You can call me, and thereafter I'll be able to explain you personally also, wherever you are. And thereafter I'll be able to explain that this Finance Act rates, Finance Act 2017, the rates are for assessment year 17-18. So we are concerned right now with assessment year 17-18. So when the Finance Act 2018 comes, will be related to assessment year 18-19. Yes, that's all. I think we are able to deal with the queries. I'm sorry, there are more queries? No, there are no more queries. And I once again thank the Chamber and the committee of Ketan Bhai for giving me an opportunity and updating me also, as I mentioned in the initial remark, that yes, we ourselves need to be updated about these provisions, which are very harsh. And you must have also seen that, yes, what are the taxes if at all we are caught, or if at all the SEC is caught, what is the amount of tax that he will have to pay, sell out. I don't think if it is worth even anything worth, after considering the professional charges, I don't think anything will be left out for an SEC for him that he would be able to spend out of anything from this undisclosed income. So with these words, I once again thank the Chamber for giving me an opportunity. Thank you. Thanks a lot. Yeah. Sorry.
Now the president asks a vote of thanks. We would like to thank Sri Mahendra Bhai for accepting our invitation to deliver his lecture. He has dealt with provision of section 115 BB, E, 271 AA, C and 271 AA B in depth. He has brought forward practical difficulties, issues which can be faced by us in implementing the provision and in completing the assessments, which can give rise to huge litigation. He has also discussed the precautions to be taken while filing the returns of income. We all will agree that it was a very good learning session. With this, I, on behalf of Chamber of Tax Consultant and on your behalf, propose a very hearty vote of thanks and request you to carry out with loud applause.
Thank you very much. ये हुआ क्या कौन सा कहाँ हुआ है कहाँ पे एक तो जहाँ पे हुआ था मेरे को मालूम है एक कौन सा स्टडी सर्कल में हुआ था